Morning, everyone. I'm going to pick up on some of the points that Rekha just made. I'm aware that the theme of this conference is primarily outsourcing, but I'll provide a little broader management perspective on some of the issues that I think are affecting this business, which tie into outsourcing, and I will address those as I go through it. So the theme of my presentation is really the Great Recession, and I'm asking, now what? First point I'd like to discuss is clearly there were storm clouds over profitability for this business, even preceding the Great Recession. Second is, how have asset managers generally responded? And for another sort of perspective, I've also looked at how general managers in other businesses outside of asset management, how they've responded to the Great Recession, just to see if there's any differences. Then I'll talk about 10 changes that I don't think come as a surprise to many of you. They're already underway, but I think they're going to fundamentally reshape this business. Then I'll talk about how to frame your business and some suggestions about what to do right now. However, I recognize that not all of you are going to take any advice that I feel I need to offer. So I've got the Yogi Berra quote down here. There are some people who, if they don't already know, you can't tell them. Asset management profitability, as I said a moment ago, was already deteriorating. Passive management was growing rapidly. Hedge funds, even those demanding extremely high fees, were taking assets away from long-only managers. I think the highest fee I ever heard of was a 5% management fee, 50% participation. Large variations existed in profitability and really always have. But I think that there was increasing pressure, particularly on long-only managers, as an example, just prior to this Great Recession. Compensation was rising as well, and the regulators were starting to close in, demanding a lot more information and introducing lots more rules. And then the storm hit. What I look at here was the S&P 500 over the last 5 years, and I've looked at annual averages using monthly closes to get a sense of how did our assets and revenues respond to the decline in markets. And as you can see, 2008 was a bad year, but 2009 is worse in terms of the average level and therefore the impact on assets and revenues. And I think it had a severe detrimental impact on the majority of asset managers. And what I think is interesting to look at is how did managers actually respond to this? The after effects, clearly this isn't business as usual. It's unprecedented, certainly in my career of 30 years. Government and regulators have certainly taken a greater interest, accelerated by, I think, the sort of populist sentiment that's out there, the Michael Moore and the like. There's a heavy emphasis that continues on cash and fixed income, which has severe ramifications for profitability going forward. Clearly, we've got a lower fee schedule for fixed income investments. Hedge funds and equity growth, private equity growth has been disrupted. Structured products, I think we became acutely aware of counterparty risk and in some cases fairly poor advice from some providers. Deleveraging was certainly a broad macro trend, and a real estate and banking collapse that I think we haven't seen the likes of for close to 20 years. My favorite line is, in that regard, on the left side of the balance sheet, nothing is right, and on the right side of the balance sheet, nothing's left. And outsourcing really came about out of necessity. So let's look at how asset management CEOs have observed the current economic crisis and its impact on their organizations. Asset attrition, obviously, number one. This is based on a survey done by Price Waterhouse this year. Asset attrition, number one. We've taken the opportunity to strategically grow, which I think is interesting. Somehow, I guess some just ignored the crisis and moved forward. Across-the-board budget cuts, certainly high priority. And we benefited from a flight to quality. There are some managers out there who have benefited from the flight to quality. And then the final points, headcount reduction, client attrition, and business divestment. A relatively small piece. There's more to talk about there, and I'll come back to that a little bit later. But there have been very strong headwinds against divesting even underperforming businesses, including the difficulty of finding financing and the like. The earnings impact really varied by business model in the asset management business. Certainly the sales culture influenced how you were able to deal with the Great Recession. In our case, we attempted to further reduce the administrative workload on our top-performing sales and client service people. Service levels, I know there's some folks from Northern Trust in the room. I was told by several clients that Northern Trust was calling their clients on a weekly basis last fall to keep them informed and comfortable with Northern Trust's approach to things. Profitability, it's an interesting issue, and I'll come back to this a little bit later. There's a lot of lifestyle businesses in this asset management world. There are many firms that pay little attention to profitability, risk-adjusted return on capital, that sort of thing. Their focus is really on having the autonomy and ego and making money, but not necessarily any sort of absolute level. So I think there's some players in this business that really are just happy, having a job and running their own business. Transaction versus relationship. By that I mean commission-based brokerage versus managing assets. Certainly that everything was affected by the decline in the markets, but I think we've seen a sharper rebound in managing assets than in commission-type businesses. At least certainly that's been our experience. Product emphasis. Certainly those involved in fixed income have benefited. But the lower fee schedules, I think, are affecting their overall level of profitability. Client segments, by proactivity, I mean some clients just stopped opening statements and didn't want to hear about anything. So some of our competitors were able to skate through this a little better than others because of passivity of their clients. Risk appetite, certainly leverage managers were most exposed. And then responsiveness. Many asset management firms either ignored the market downturn or, I think, wondered what happened. This is a McKinsey study that was done earlier this year, and they looked at the expectations for asset managers in 2009 in terms of profitability over 2008. On the left-hand side, they show decisive operators. And these are managers that aggressively responded to the decline in assets and revenues. The purple and red bars in each of these cases show the expected decline in assets and revenues for 2009. And then the blue bar shows the expected decline in profitability as a consequence. Really, only 13% of firms in this survey took aggressive actions to reduce costs. So everyone was expecting a 20% plus decline in the markets in 2009 and in revenues in 2009. But really, only 13% of managers actually reduced their costs by a like or higher amount. The third group is, and they're referred to as decisive operators, the third group is referred to as depressed and in denial. These people were also expecting a major decline in assets and revenues in 2009, but did virtually nothing about it. They just sat there frozen, which is astonishing to me. Here's another additional perspective on how CEOs sort of responded to this. This, again, is from the Price Waterhouse survey. So CEO focus at the current time, or at the time of this survey, acquisition and retention of clients was number one. Managing through the economic downturn, a kind of catch-all category, I guess, was number two. Managing risks, certainly none of us can afford to make risks at this stage, was number three. Interesting to me, improving profitability was number four. And then cost reduction, business refocusing, investment performance, acquisition and retention of key staff, and entry into new markets rounded out the top 8 issues. Let's look and turn to what are managers in businesses generally doing. Ernst & Young did a survey in June of C-suite executives on a global basis, large companies, to see how general business people are responding to the Great Recession. Cash is king. Protect your assets. So CEOs are looking at profitability very closely, looking at pricing, looking at customers, who can they serve profitably, and risk management, again, can't afford mistakes. They're looking to improve performance, and one key element here is their operation supply chain. In our case, we've scrutinized every major supplier to our firm, and we've looked at either terminating relationships, switching relationships, or attempting to renegotiate better deals. Reshaping the business, people that have cash are in the catbird seat and are looking at acquisitions. There is outsourcing going on, and divestiture of non-core assets or reallocating resources to more profitable opportunities is certainly underway. And then as far as future orientation, looking to new geographies where people can utilize their skill sets in different geographies, and strategic alliances are certainly on the agenda for CEOs in general. Priorities, though, profit number 1. Contrast that with the prior survey for asset managers where profit was a number 4 and how few managers really responded decisively. Sales and customer loyalty were high up on the agenda, though, both for asset managers as well as companies generally. Now I'll turn to talk about some of the big changes that are already underway, and I'll talk about these in a little more detail in a moment. First is taxes are going higher. Second, investment firm profitability won't return to the levels that we've seen prior. Passive management will continue to accelerate in importance. Distribution is consolidating, and there's a smaller number of scale players that are really benefiting from this. I think there's a lawsuit cyclical rise that's going to affect our businesses. Technology implementation, I think we'll see some delays in actually doing things that need to be done right away. Investors will continue to fight the last war, and I'll explain what I mean by that in a few moments. Fiduciary is the new standard, and I think it's confirmed. There's no more just suitability requirements. I don't think it's a scale business for most players, if it ever was. And finally, industry consolidation is likely as sources of financing begin to open up. Taxes are going higher. The rhetoric certainly suggests this, and not just income taxes. I think we're going to see user fees, value-added taxes, all sorts of things to try to restore the country's financial position. As a reminder, probably not necessary for most people in the room, but the highest marginal tax rate was 70% in 1980. Difference this time is that there are fewer obvious loopholes.